Why Warren Buffett doesn't invest in real estate. Hey guys, today we're going to talk about why Warren Buffett doesn't invest in real estate. Let's get right into it. Buffett is a savvy investor, but he's wrong on real estate. Given that he's a multi-billionaire, it's safe to say Warren Buffett knows a thing or two about being a successful investor. After all, he's made a name for himself by investing in high-quality companies. Physical real estate, on the other hand, is an investment that Buffett has long avoided. There aren't a lot of income properties in Buffett's portfolio. In fact, Buffett has long stated that he does not consider purchasing real estate to be a good investment. Warren Buffett's long-term investment strategy has proven successful in virtually every market condition over the last several decades, including recession, high inflation, and deflation. Buffett's dedication to his strategy is what has made him one of the most successful investors in history. Over the years, a plethora of new investment techniques and algorithms have come and gone, but Buffett has stuck to his relatively simple strategy of picking solid companies and focusing on long-term growth while ignoring the noise that causes most investors to panic. It may appear strange that someone with such a disciplined long-term approach to investing hasn't purchased real estate besides a 40-acre farm and his personal residence, especially since Berkshire Hathaway Vice Chairman Charles Munger made his fortune through real estate. Buffett is not opposed to real estate investing and has invested in a number of real estate investment trusts over the years. He understands, however, that becoming a landlord makes little sense. Purchasing and managing real estate is more of a business than an investment. And Buffett understands that this time is better spent selecting companies to invest in than running a real estate business. Real estate is a tricky business that often requires several properties to be scaled in order to build significant wealth. Many individual investors enter real estate under the impression that it is a passive investment, and most eventually exit those properties once they realize what they've gotten themselves into. Real estate investing is a different story. Passive real estate investments enable investors to reap the benefits of this profitable asset class without having to manage it. The FTSE Nareit All Equity REITs Index has outperformed the S&P 500 in total returns during 13 out of the last 20 years, producing an average total annual return of 13.1% versus 11.1% for the S&P 500. Many investors who have turned to private markets for passive real estate investments have seen even higher returns on average. For example, since 2014, the real estate crowdfunding platform Realty Mogul has generated an average internal rate of return of 17.2% for investors on fully realized deals. Passive investors can now purchase shares of individual rental properties for as little as $100. Since its inception last year, the Jeff Bezos-backed real estate investment platform has fully funded over 150 rental properties worth more than $60 million. Buying and managing real estate is a profitable business, but it's important to remember that it's a business, not a passive investment. The returns on investment in real estate are a direct result of the time, energy, and money invested. While that business has produced many great fortunes over the years, it is simply not a business that most people can afford. While he is certainly entitled to his opinion, you may want to take a different path when building your portfolio. Buffett does not invest in real estate because he believes it is difficult to profit from. However, there are several advantages to investing in real estate. To begin with, owning a rental property is an excellent way to generate passive income. And if you want that income to be truly passive, you can outsource the upkeep of your rental home to a property manager who can handle everything from renewing leases to making sure snow is cleared after a storm. Second, purchasing physical real estate can help you diversify your investment portfolio. If you're currently invested in stocks, real estate exposes you to a different sector and market. This could be significant during periods when stocks underperform. The stock market and the real estate market do not always rise and fall in lockstep. Just consider the events of the last 7 months or so. While stock prices have fallen, home prices have risen. Owning income properties provides you with some protection in this regard. Furthermore, home values have a natural tendency to rise over time. One rule Buffett insists investors follow is to hold investments for a long time rather than trying to get rich quickly. So if you're willing to hold on to an income property for many years, you might find that when the time comes to sell, you're looking at a very nice profit. There's nothing wrong with following Warren Buffett's investment advice. That doesn't mean you have to take the same approach he has. Buffett may not be drawn to physical real estate, and he may even consider it a bad investment. But if you disagree, that's reason enough to give it a shot. Remember that if you want to invest in real estate but aren't sure if you want to load up on physical properties, you can always add real estate investment trusts or REITs to your portfolio instead. Owning publicly traded REITs is similar to owning stocks, except that you gain exposure to the real estate market. Furthermore, REITs are known to pay above-average dividends, and reinvesting those payments is another excellent way to accumulate a large amount of wealth over time. That's all for today, and we'll be sure to catch you all in the next one.